Hello and welcome to MF Corner. I am Sonal Bhutra and with me as always is Vinny Motiwala. Well, Vinny, today on the show we are going to be speaking about this NFO which is coming in from Bandhan AMC. It's a healthcare fund, so you would also be interested in this one because you track that so closely. But let's talk about the fund first up before we speak to the guest on the show today. It opens on November 10th and closes on November 24th. So these are the dates for this particular fund. The benchmark is BSc Healthcare TRI and the fund managers for the equity portion, it is Mr. Viraj Kulkarni, and for the debt portion, it is Mr. Brijesh Shah, and Ms. Ritika Behra and Mr. Gaurav Satra will manage the overseas portion of this particular fund. The risk factors that they have mentioned in their presentation include the valuation risk. We'll, of course, ask the fund manager about it, a volatility and concentration risk, and any regulatory risk which would come by considering the sector that they are investing in as well. But who is this fund suitable for? Investors who are seeking a high exposure to high potential growth sector fueled by structural mega trends. We'll discuss those trends in greater detail. Those who are looking to diversify with thematic strategies which will have both growth and defensive characteristics, and also investors which are comfortable with higher volatility because it is a long-term plan. Potentially higher returns is something that it would offer compared to broad market funds. So these are some of the aspects of this particular fund. So let's get in. The fund manager, Viraj Kulkarni, who is the Vice President Equities at Bandhan AMC, is joining us now to take a few questions. Thank you so much, Mr. Kulkarni, for joining us today. The fund presentation says India's healthcare spend is only 5.4% of GDP versus 16.5% in the US. How soon do you expect India to bridge this gap meaningfully? What are the key triggers? And are these the triggers which are making you so bullish on this particular space?
Thanks for having me on your show. That's a very relevant question that you brought up front. So I think there is a broad trend that is playing out in India, which we want to capitalize on. It's the demographic aging of our society. So today, where our median age is around 28 years, in the next 20-25 years, our median age will be around 38 years. So median age is nothing but the average age of the population. And this trend is very obvious because our fertility rates have dropped below the 2.1 level, which is essentially the replacement level. Which means that going forward, there will be lesser young children that are being born than what are already there in the system. We live longer, our life expectancy goes up. That means that the average age of the society is going to go up. When the average age of the society goes up, the society ages, the nature of spends are going to dramatically shift from education, children's marriage, bringing up kids, etc., to other places like healthcare, discretionary consumption, travel, etc. And as societies age, as chronic ailments start much earlier in life and become very prevalent, the spends on some of these chronic ailments like blood pressure, sugar, etc. are also going to meaningfully increase over time. So that is why we see this as a structural trend playing out in not just in India, but also globally, because some of the global leaders have also called out that the world is aging and demographics is destiny. So I think that is the mega trend that we are trying to play over here in India and globally. If we take the example of the US, when the US aged from a median age of 27 to 37 in a period of 30 to 40 years, from 1975 to 2015, during that course of time, their healthcare spends as a percentage of GDP doubled. Also in India, even if we don't go from 5% to 15% or 16%, see, the US is far richer today than even the US was far richer in 1975 than what India is today. So their spends on healthcare will always be higher than what we do, even as a percentage. But can that 5 go to 7, 8, 10? That is the question. I think the answer is yes, because as we age and we become richer, our spends on healthcare are only going to go up. So that's the structural trend that we are trying to ride over here.
Okay, that's a structural trend that you all are looking to ride. But at these valuations also, Viraj, given that when you're looking at it, BSc Healthcare is somewhere times 37 times PE, which already seems a bit elevated, right? So then what will justify you starting this at these valuations, or how would you expect more growth?
Okay. So if you look at the BSc Healthcare Index, the trailing P on a long-term basis has been close to that 35 ballpark as such. It's a stable sector that generates very healthy ROEs and cash flows. Such sectors, just like FMCG, always get a multiple which is higher than the market. because with FMCG also we see the same story as such. And if we compare the current valuations to the long-term averages, the valuations are not very far away from what a 10-year average was. In fact, the valuations have come off meaningfully over the last 1 year. Last year, the sector was at 20% premium to what we are today as such. So we look at it as a structural growth sector available at valuations which are close to fair value or slightly more than fair value for the sector. Also, healthcare being a defensive is a sector which typically tends to outperform market corrections. That has always played out in the past. Whether it will play out or not, we can't be 100% sure. So I think, yeah, sorry.
Oh, okay. No. So I just want to understand that you've said that given the underrepresentation of healthcare in Indian indices, that is around 6% of Nifty 500,
Correct.
is this more of a structural opportunity, or do you look at it as a cyclical opportunity and goes into the thematic theme overall?
No, so we don't look at, so that is where we are trying to be slightly different. We are not looking at this thematic fund as a cyclical opportunity, wherein we want to play a 1-2 year upcycle in healthcare. We are looking at it as a structural opportunity, wherein we think at 6.5% as a percentage of the index, the weight of healthcare is very low. With the healthcare sector now becoming more domestic focused, we see that this weight can only go up meaningfully. There will be cycles. It will not go up in a linear fashion. There will be ups and downs, but the broad trend will be upward. So we are trying to play this structural trend over a 5-7 year period, and we don't look at it as a 1-2 year thematic opportunity as such.
You've also mentioned a balanced 20-30% allocation across 4 segments: domestic, branded, hospital and diagnostic, CDMO, API and export side, right? What parameters will determine this tactical overweight? Is it more tactical or underweight calls among these? How will this be working out?
So we want to go bottom up, but while we go bottom up in a sectoral fund, we think that there are these 4 segments of the market, which is generics that we export largely, domestic branded pharma, hospitals and diagnostics, and CDMO. These are 4 distinct segments within the pharma space. Each of these segments, we want to have 20-30% exposure. We are reasonably bullish or reasonably confident on the long-term growth trajectory of these trends or these themes or these 4 subsegments. And each of these segments has a role in the portfolio as per us. So we are not building a fund which is skewed like we want to own only hospitals or only CDM or something like that. We want to build a balanced fund with a 20-30% allocation to each of these subsegments. Now, on a bottom-up basis, if we find a lot of ideas in a particular subsegment, say generics, we'll be closer to 30%. If on a bottom-up basis, we don't find many ideas, we'll be closer to 20%. But the idea would be to discipline, because it's very difficult to predict next year which of these subsegments will be the big outperformer or underperformer. So the idea is to be allocated within that 20-30% band at all times, and tactically being 20-30 depending on the opportunities that we can find.
Okay, all right. We take that point and we have a lot more questions to ask as well, but we have to take a quick commercial break. When we come back, we'll continue the discussion on the other side.
CNBC TV18, we still have with us Viraj Kulkarni, Vice President Equities at Bandhan EMC. We're discussing the Bandhan's Health NFO fund, which is going to be launching next week. Viraj, how will this fund balance the exposure that one could see between defensive healthcare plays, maybe like hospitals, right, and growth-oriented pharma, CDMO, opportunity-wise? What will be that?
So the balance could be either in the defensive or aggressiveness could either be in terms of the market cap also, because you would have some large cap opportunities over there and some mid and small cap opportunities over there, as well as the defensive in terms of generics or domestic pharma, and the more aggressive in terms of CDMO. So if we just try to fit in, the idea is to find the stocks wherein the fundamentals match the valuations to that extent. We are not so concerned whether it's a large cap or mid cap or small cap, or if it's a defensive or an aggressive growth company. Anyways, we have put a broad framework wherein we will have a 20-30% allocation to each of these themes, CDMO, export generics, hospitals, etc. But within that, all the stocks where the valuations matches the fundamentals we like. If we find more such ideas than can fit in the fund, then obviously we have to filter down to the best ideas. But in the current market, it's not that the markets are so cheap that you find lot of ideas out there. The handful of 25, 30 ideas where valuations match fundamentals, we are very happy owning those. Some of them could be lower growth but more defensive, which could be the mega caps or the generic companies or the domestic pharma companies. Some of those could be higher growth but higher risk in CDMO, some small hospitals as such.
Okay, we take.
Ideas have a balance. Sorry.
No, please continue.
No, that was the last thing. If you have a balance, the idea is not to skew either too much on the risk or the defensiveness curve. Idea is to have a balance between these two.
Take that point. So in that case, I know you said that there is no particular allocation that you'll have for large caps or mid or small caps. But you know, the general idea is that large caps have more stability, mid or small cap will have higher growth potential. Currently, how are you looking at valuations across the two segments in the healthcare space itself?
Yeah, I think for healthcare, it's largely true or similar to the rest of the markets. Because the broader markets, if you see, large caps seem to be reasonably valued and the earnings expectations also seem to be quite reasonable. So even if some of the mid caps or small caps have higher growth, the expectations are very high in terms of earnings, and some of the multiples are also not very attractive broadly. So in the current market, we would have a bias towards large caps, not because we like large caps, but on a bottom-up basis, we would find more ideas over there. But as the markets have been sideways for the last 1 year, there are a large number of, or there are at least few stocks in the pharma small cap space or mid cap space, which have corrected 20, 30, 40% from their peaks. And that opens up opportunities for stock picking over the next few months as such.
Okay, sure. That's interesting there. But Viraj, you know, what about healthcare stocks globally? Because they have outperformed the S&P 500. Do you expect Indian healthcare to mirror that trajectory, and maybe then we could start seeing that outperformance now?
See, the global stocks have outperformed largely on the GLP-1 theme. And there are two companies that Novo Nordisk and Eli Lilly who are riding that theme as of now, and there are some ancillaries over there. In India, we do not have any of these innovator companies on that theme as such. And I think that is why we should keep our expectations reasonable. This is a sector that can give us reasonable compounding higher than the market for the next 5-7 years. We are not expecting some sharp re-rating in the next 1 or 2 years by any of these trends as such. It's like AI. AI is doing well globally, but in India, we do not have many AI plays. Similarly, GLP-1 themes are doing well globally. In India, we have few names, but they are very small and very few, so that the sector may not do that well as the global sectors have done.
Okay, so in that case, I know I'm not sure what exact answer would be to the next question that I'm going to ask you, but the investors would like to know what would be your 3 to 5 year return expectation relative to the BSE Healthcare TRI benchmark?
So the way we want to put it is, without giving an actual return expectation, the way we want to run a fund is, if the market can compound at a certain level, we hope or we are expecting the healthcare index itself to compound higher than the market. If you take 20-year returns of the BSE Healthcare Index, it has given 2.5 percentage points returns higher than the Nifty. Nifty is some 12.5%. BSE Healthcare Index is some 14.9 or 15% compounding for the last 20 years. We believe that this can continue given the structural trends of aging population. So index itself should be able to give 2 to 3% delta over Nifty or the broader markets. And we would expect to generate anywhere between 2 to 4% alpha over the medium term. That would be the endeavor over the healthcare index.
Okay, you know, what sort of investors should maybe look at this fund, right? Maybe could it be in the core holdings, or do you think maybe it's more like a satellite thematic exposure that one should view this fund as?
I wouldn't put it in a core holding, to be very honest, because core 70% of your portfolio would be the flexi or the large cap or the large mid or some of the hybrid funds. That would be the core of an investor's portfolio. This is a part of the 30%. Wherein you have exposure to sectors which can grow faster than the market. It could include mid caps, small caps, or some select sectors like healthcare. So within that 30%, maybe a 5-10% exposure would be ideal.
That's very candid and honest of you to say that it should not be a core portfolio, but satellite, yes, it would work wonders for someone's portfolio. But, you know, since this is a single sector fund, what internal guardrails do you have for volatility, concentration risk? Concentration is one thing that you have also mentioned into your presentation for this NFO.
Yeah, so I think it's a single sector fund, but within the sector, the 4 segments that we have identified, for example, what happens in hospitals in India is in no way connected to what happens in generics or a generic exports to the US. So even though it's a single sector, the 4 sub-segments are largely uncorrelated with each other. So that's a good thing because it means that if there is some tariff put on generic exports, it only impacts 22% of the index. The rest of the index is largely impact free to that extent. Also, that is, I think the sector itself is naturally diversified. That is good for us. On the guardrails, all our funds have a fund casing to that extent, wherein this 20 to 30% exposure to each sector will be one of the guardrails. Then the starting weight of mid and small caps is another guardrail, especially small caps. We will not start with, say, a 5% weight to a small cap stock. The starting weight has to be 2-3% or something like that. So I think those would be some of the guardrails that we put on ourselves as such.
You know, Viraj, one big issue or a risk that comes in is regulatory risk, right? Because that plays an important role, especially in the pharma sector, the US FDA approvals or dependency over there. How do you assess this risk?
So this risk is something that we have to live with. Again, the lucky thing, see, if we go back to 2015, 70% of the index was export generics, wherein US FDA had a large say on what happened to the sector. Now only 22% of the index is US generics. So that regulatory risk is there, but then you work with it. So you look at companies which have more diversified manufacturing base. Because if one of their plant gets a FDA warning letter or FDA issue, or maybe some of their other plants can supply. Or if you look at countries or companies which are supplying to multiple countries, not just the US. So companies supplying to US, Africa, Asia, etc., diversified presence as such. So I think that is how we will diversify away the risk to some extent. Look at companies with diversified exposures. Look at the valuations, because if the valuations are cheap, and some negative news comes, the downside is always limited. So there are multiple levers to mitigate issues. The most important or the best thing for us is that 22% gets impacted by US FDA. Only 24% is hospitals which gets impacted by domestic regulators. 36% is domestic pharma which has a different regulator. So unless and until all regulators come up with a negative view at once, then it's a problem. But otherwise, only if one regulator comes up with some negative view, it impacts only one section of the fund, which will be between 20 to 30%.
US FDA continues to be that big, I would say, looming risk for any pharma company, right? There's a US FDA note and everyone's like, what the impact of that one? Last question before we let you go. India's share in the global CRDMO space, you know, this is one space that's been heating up. It's around 3.6% and the space is expected to grow by 9 to 15%. But we still talk about that China plus one factor. So will you look at some of these exposure stocks which will be able to ride on that theme?
Yeah, we will definitely look at it. So see, that China plus one theme has been playing out across sectors. Some places it has worked, maybe electronics. Some places it hasn't worked, something like a chemicals. Because that China plus one has been talked about, but we haven't seen big growth pickup in that space as of now. So we are not banking on the theme per se. If it works out, great. We'll work more on a bottom-up basis for these CDMO companies. We'll have exposure of 20 to 30% to even CDMO, but the idea will be to look at it on a bottom-up basis where we are looking at the pipeline of that individual company, what kind of opportunities it is working on with innovators or other companies. And if we think that the pipeline is good enough, we'll go and invest in that company. We'll not necessarily bank on a broad-based China plus one playing out as such.
Okay, Viraj, surely thank you so much, for joining us today, because this is a very important space. Everyone's keeping an eye out on this one as well, the healthcare side, and a new fund coming in and starting on 10th of November. So that is what everyone's watching out for. But to hear what the details that were listed out of the fund or how they're planning to invest and going forward, what are the risks, challenges and the pros and cons over there as well. But thanks so much, Viraj, for joining us. But Thank you so much for tuning in as well, viewers, to MF Corner. As always, with that, it's a goodbye from Sonal, myself, as well as the team who put this show together. Don't go anywhere. Last hour of trade is still left, and closing bell is up next for that.